Silver isn't running hot. It's being repriced in real time, and the people who live off calming you down are already trying to frame this as a temporary fever. They'll point at the vertical chart and tell you it's emotion. They'll talk about profit-taking, overbought, froth, and the inevitable snapback. But the chart is not the part that matters. The part that matters is the way the market is charging for time and immediate delivery, because that's where stress shows up first. And if you stay with me through the mechanics, you'll know exactly what to watch over the next 1 to 2 weeks. What level matters, what breaks the thesis, and why a number like 309 even enters the conversation without turning this into fantasy math. Because this move isn't a vibe, it's math. And the math is starting to corner people. Here's what just happened, stripped of drama. Silver didn't just climb, it shifted behavior. There's a difference. A normal uptrend climbs, breathes, and respects liquidity. Over pricing jumps rails, it starts to ignore the old pacing. It gaps in thin moments. It punishes hesitation. And the moment silver pushes into record area territory, every participant stops acting like a casual trader and starts acting like a risk manager. That sounds subtle. It isn't. Risk managers don't care about your narrative. They care about where they're forced to act. And that's where the real pressure starts. Now, I know what you're thinking, because you've seen this movie. A parabolic run, social media screaming, and then a brutal wick down that makes everyone feel stupid. That can happen. It often does. But if you only watch the headline price, you'll miss the hidden detail that tells you whether that wick is a healthy retest or the first crack in the structure. The hidden detail is this. In a real tight market, the argument moves away from what or S the fair price, and toward who can source it, who can finance it, and who is forced to pay up right now. That shows up in term structure, in spreads, in the cost of immediacy. It shows up before your favorite commentator updates their talking points. And if that one layer stays stressed, the upside can become convex in a way that makes normal targets look like they came from a different planet. But that's not the part that matters. The next detail is what flips the whole setup. Silver is one of the few markets where you can watch the negotiation between paper and physical happen in public. Most people don't realize how many silver prices exist at the same time. There's the headline spot. There's the front month futures price. There are forward months. There are OTC quotes. There are the prices implied by lending metal, by borrowing cash against metal, by storing it, insuring it, transporting it. There's what large industrial buyers are paying through procurement contracts. And there's what retail pays when the supply chain gets pinched and premiums jump. In calm times, these prices move together enough that nobody cares. In stressed times, the gaps become the story. Because gaps tell you where the market is fighting. And right now, the fight is over immediacy. So let's make the mechanism simple, because if you can't explain it in plain English, you can't trade it, you can't risk manage it, and you can't trust your own thesis when volatility tries to hypnotize you. Futures markets are supposed to be a clean bridge between today and later. When a market is comfortable, later is usually a little more expensive than now because storage, financing, and time cost money. That's the normal carry logic. But when a market is tight, the front end can start commanding a premium because the market is effectively saying, I don't need to care about later, I need it now. That's not a conspiracy. That's a price signal. It's the market charging you for immediacy. And when that starts to happen, while price is already elevated, it tells you something important. The demand is not just speculative paper chasing a chart. It's a scramble to secure near-term exposure without getting trapped by delivery risk, margin stress, or sourcing issues. And that's where the real pressure starts. Now let's talk inventory, because this is where people get fooled. Not all inventory is supply. Not all stay-used silver in warehouses is silver that can be delivered tomorrow to satisfy a tight front month. In most warehouse systems, you effectively have categories. Some metal is deliverable against futures contracts. Some is simply stored there but not pledged for delivery. Some is owned by parties who have no intention of parting with it at current prices. Some is tied up in financing deals where moving it would break another contract. Some is not in the right form, the right bar standard, or the right location for immediate delivery without time and cost. The headline number can be huge and still feel tight at the margin, because what matters in stress is the marginal available unit, the last unit for sale, the last unit that can be mobilized in time. And when that marginal unit becomes scarce, the price behavior changes. It becomes jumpy, it becomes violent, it becomes a market where spreads scream before the chart does, because if this one layer breaks, the math changes. And this is where a lot of the mainstream commentary gets lazy. They'll say there's plenty of silver, because in geological terms, silver exists. Or they'll say inventories are fine because totals exist. But the market doesn't trade geology, and it doesn't trade totals. It trades deliverability, financing, and timing. It trades whether industrial buyers can lock supply without paying a panic premium. It trades whether a short can roll without paying a spread penalty. It trades whether a dealer can hedge options exposure without becoming the buyer of last resort into a squeeze. In other words, it trades structure, and structure is what you need to watch this week. Here's why that matters for the 309 idea without turning this into a carnival. In markets that are normally liquid and deep, upside is mostly linear. You can model it with normal assumptions. But in markets where liquidity thins and positioning becomes one-sided, upside can become convex. Convex means small changes in pressure create disproportionately large moves. Think of it like a door that swings freely until it hits a narrowing hallway. At first it's easy, then suddenly it jams, and the force needed to keep moving goes up fast. Silver can do that because it sits at a weird intersection. It is a monetary metal for many investors, and an industrial metal for real buyers. That dual identity matters. When investors chase it for macro reasons and industry needs it for production, you can get a tug of war where neither side can fully step away. Investors don't want to miss the move. Industry can't simply wait if supply contracts and production schedules require metal. And when that happens at the same time as market structure stress, the repricing can look irrational on a chart while being brutally rational in the plumbing. But that's not the part that matters. The part that matters is what forces participants to do next. Let's get concrete about forces. The first force is margin. When silver surges and volatility spikes, exchanges and clearinghouses often respond by raising margin requirements. That is not a moral judgment. It's a risk control mechanism. But the real-world effect is simple. It forces leverage participants to post more cash or reduce positions. That's it. And that can create sudden sell-offs that look like the top, even if the underlying tightness hasn't changed. It's the market shaking out weak hands. It's a liquidity event, not necessarily a thesis event. And the trap is emotional. People interpret a margin-driven flush as proof the whole move was fake. Then the structure tightens again, and price rips while they're on the sidelines. This is how volatility weaponizes your psychology. It doesn't need to convince you with logic. It just needs to scare you into acting at the wrong moment. And that's where the real pressure starts. The second force is the roll. If you're short futures, you don't have to cover in the dramatic sense every day, but you do have to manage expiries. You have to roll from front month to next month if you want to maintain the short exposure without taking delivery obligations. In a normal market, rolling is relatively smooth. In a tight front-end market, rolling can be expensive. The spread can move against shorts. It can become a tax on staying short. And when that tax rises, some shorts choose to exit instead of paying it. That's not ideology, that's risk management. And when enough participants make that same choice in a window of thin liquidity, you get bursts, short covering cascades, that look like a squeeze even when no single villain exists. It's a system doing what systems do, forcing alignment. But that's not the part that matters. The next detail is what flips the whole setup. The third force is options hedging. This is the part most retail investors sense but can't articulate. Dealers who sell options often hedge their exposure dynamically. In plain English, if a dealer is short calls, rising price can force them to buy the underlying to hedge, especially as price approaches key strike levels. The closer you get to certain strikes near expiration, the more sensitive that hedging can become. That's the gamma effect. Sometimes it's mild, sometimes it becomes reflexive. Price rises, hedging buys, which pushes price, which increases hedging needs, which buys more. Not always, not guaranteed, but possible. And when the calendar aligns, weeklies, month-end, big expiries, it can turn a normal breakout into a fast, almost mechanical surge. And that's why the calendar matters so much right now. So here is your why now trigger, and it's not mystical. In late January, liquidity can thin compared to peak periods. The market starts staring at the next policy window, the next big event risk, the next round of positioning decisions. Month-end is not a superstition. It's a real scheduling boundary for funds, for risk reports, for rebalancing, for hedges that must be reviewed. Option windows and expiration cycles create forced decisions. If you're a dealer, you can't just believe something. You have to hedge it. If you're a fund, you can't just wait. You have risk limits. If you're a producer or a consumer, you can't just hope. You have procurement timelines. That's the calendar as catalyst. And the next 1 to 2 weeks can matter more than the last 2 months because windows force action. But that's not the part that matters. The part that matters is what the market is paying for time inside those windows. Now let's stack proof like professionals do, because one argument is never enough. The first proof point is term structure itself. When the nearby month starts behaving differently from the back months, you're seeing urgency. You're seeing the market assign extra value to immediacy. That doesn't guarantee higher headline price tomorrow, but it tells you something about the stress in the system. It tells you that the marginal buyer is not patient. The second proof point is warehouse and deliverability data. Not the total number, but the trend, the composition, and the relationship between deliverable and stored. When deliverable categories tighten relative to demand, it matters even if total inventories look ample. The third proof point is spread behavior during pullbacks. In a healthy repricing, you'll often see price pull back while the underlying structure doesn't fully relax. That means dips are being bought for real reasons, not just meme momentum. The fourth proof point is flow behavior in silver-linked vehicles and futures positioning. When participation broadens, the market can become more reflexive. Flows can amplify both directions, which is why you never worship flows. You monitor them as a fuel gauge. The fifth proof point is cross-market behavior. How silver trades relative to gold, relative to the dollar, relative to real yields, relative to industrial indicators. If silver holds strength even when typical headwinds appear, that's information. And that's where the real pressure starts. Now, about the chart, because yes, levels matter. In a repricing, the market tends to anchor to round numbers and prior highs because that's where risk managers place lines in the sand. And when silver is in the 70s, 80s, 90s, the first psychological battlefield is usually the century mark. Not because 100 is magic, but because human systems use round numbers to organize risk. Above that, you start seeing a different type of participation. Trend followers who are forced to acknowledge the breakout, hedgers who are forced to adjust, and skeptics who keep shorting because it can't possibly hold. That skepticism is fuel, but only if the structure stays tight. Key zones are not single ticks in this environment. They're areas. Think in bands. Support becomes an area around the last consolidation, the last sharp impulse low, the last place where liquidity actually printed size. Resistance becomes an area around fresh highs, around the round number, around the strikes that matter into expirations. If price retests a breakout zone and holds while spreads and structure remain firm, that's confirmation behavior. If price loses that zone and structure relaxes hard, spreads ease, urgency disappears, that's weakening behavior. That's your risk map. But that's not the part that matters. The part that matters is how volatility will try to manipulate you while this plays out. Because volatility is going to be violent even if the thesis is correct. Let me say that again. In a way that saves people money, you can be right on the direction and still get wrecked on the path. Silver is famous for this. It whips, it punishes leverage, it creates headlines that feel like verdicts and then reverses them. That's not evidence that the market is fake. It's evidence that the market is thin and emotional at the edges, and that participants are forced to act in bursts. The psychology trap is simple. When price spikes, your brain believes it will keep spiking. When price dumps, your brain believes it's over. That's how humans are wired. The market uses that wiring against you. It doesn't need a grand plot. It just needs enough participants to panic the same way at the same time, and that's where the real pressure starts. So build a viewer psychology shield right now before the next downdraft tries to steal your conviction or the next rip tries to make you chase like an addict. The shield has 3 parts. First, separate trend signal from noise. Trend signal is structure. Higher highs that are defended, dips that are bought with speed, spreads that stay firm, and macro conditions that remain supportive. Noise is intraday volatility driven by margin, liquidity gaps, or headline flares that reverse within hours. Second, always keep 2 scenarios in mind so you don't become emotionally married to one path. Third, choose invalidation before you choose a target. Targets are seductive, invalidation is discipline. If you know what breaks your thesis, you stop negotiating with your emotions in the middle of chaos. But that's not the part that matters. The part that matters is how the next 1 to 2 weeks can force the market into one of 2 clean paths. Here are the 2 scenarios, and I'm going to keep them brutally practical. Scenario 1 is the controlled pullback and retest. In this scenario, silver has already repriced, and now it needs to digest. You get a sharp pullback, maybe triggered by margin pressure, maybe triggered by a dollar bounce, maybe triggered by simple profit taking into a prior breakout zone. It scares people. The headlines flip. Commentators declare it over. And then, if the thesis is real, you see defense. Not necessarily a V-shaped moonshot, but a stabilization. You see buyers step in with intent. You see dips bought faster than expected. And most importantly, you do not see the structural stress disappear completely. The market still pays for immediacy. Spreads remain firm. Deliverability doesn't suddenly look comfortable. That's the controlled retest. It's bullish if it holds. It's a gift if you're disciplined. It's also the path that most people emotionally fail, because it feels like betrayal right after euphoria. Scenario 2 is the continuation squeeze and gap risk. In this scenario, silver doesn't give the crowd the polite pullback they're waiting for. It stays elevated, chops, and then pushes through the next psychological level in a window where liquidity is thin. Dealers hedge, shorts flinch, momentum funds chase. And you can get gaps, moves that happen so quickly you don't get the entry you wanted, and you don't get the exit you planned if you're on the wrong side. This scenario is where upside targets start to get ridiculous on a chart, and That's where the 309 conversation even becomes relevant as a squeeze case projection rather than a base case expectation. It's the path where convexity dominates. It's also the path where the market is most likely to punish greed, because continuation squeezes often come with brutal snapback wicks that wipe out over-leveraged late buyers. This is why you don't confuse possible with safe. But that's not the part that matters. The part that matters is what confirms each scenario in real time. Confirmation is not a feeling, it's a checklist. For the controlled retest, confirmation is price respecting a prior breakout area and reclaiming it quickly after a probe lower, while volatility begins to compress and structure stays relatively supported. You want to see the market refuse to get comfortable again. For the continuation squeeze, confirmation is price holding above key psychological thresholds and accelerating into expiration windows, with liquidity visibly thinning and pullbacks failing quickly. In both cases, the red flag is the same, a break of the key structural zone followed by persistent weakness and relaxation in the urgency signals. If the market goes from pay for immediacy back to time is cheap, that's a warning that the stress has eased. Not a guarantee of collapse, but a change in regime. And when regimes change, targets change. Because if this one level breaks, the math changes. Now let's address the bear case cleanly, because trust is built by respecting the ways you can be wrong. The cleanest way this rally fails is not silver was a scam. The cleanest way it fails is a tightening in financial conditions that forces broad de-risking. If the dollar catches a strong bid, if real yields surge, if policy rhetoric shifts hawkish, if risk assets wobble and funds need to raise cash, silver can get sold because it is liquid. Liquidity is a blessing until it isn't. When funds need cash, they sell what they can sell, not what they want to sell. Another failure mode is positioning exhaustion. If too many participants are already all in, there's nobody left to buy the next leg without fresh catalyst. Another failure mode is flow reversal in silver-linked vehicles. Flows can be one way until they are T, and outflows can amplify downside just like inflows amplify upside. And then there's the simple fact that a vertical chart invites political and institutional caution. Higher margins, stricter risk limits, tighter financing. None of that proves the long-term story is wrong. It just changes the near-term path. And the near-term path is where most people lose. But that's not the part that matters. The part that matters is how a correct thesis can still be traded incorrectly if you don't understand the forced behaviors. So let's go back to the forced behaviors, because this is where the market becomes mechanical. In a tight structure, shorts face a choice: pay the spread tax, post more margin, or exit. Dealers face a choice: hedge more aggressively or accept open risk into expiration. Industrial buyers face a choice: lock supply at uncomfortable prices or gamble on a pullback that might not arrive in time. Funds face a choice: respect risk limits or let a winning position become a career risk drawdown if volatility reverses. Every one of those choices creates buying and selling that has nothing to do with sentiment and in the way pundits talk about it. It's not mood, it's obligation. And obligation is the hidden engine of reflexive moves. That's why the market can rip on no news, because the news is in the structure. The market is the news. But that's not the part that matters. The part that matters is what you should watch next without getting hypnotized by daily noise. Here's your near-term roadmap for the next 1 to 2 weeks, and it's designed for people who demand logic, not vibes. First, watch the behavior around the big psychological thresholds. If silver is pressing the upper end of its recent range and flirting with round numbers, observe whether pullbacks are shallow and quickly bought or deep and sticky. Shallow and quick suggests continuation risk. Deep and sticky suggests digestion or breakdown risk. Second, watch the moments of thin liquidity. Late sessions, early sessions, post-headline bursts, weekend gaps. In a squeeze case, those thin moments produce upside jumps. In a failing case, those thin moments produce air pockets down. Third, watch whether stress signals calm down when price pulls back. If price pulls back and the urgency disappears, that's not great for the immediate squeeze narrative. If price pulls back and urgency stays stubborn, that's the market telling you the dip is not resolving the underlying issue. Fourth, watch cross-market context. If the dollar spikes and silver shrugs it off, that's information. If real yields rise and silver holds, that's information. If gold softens and silver stays firm, that's information. Silver doesn't have to win every day to be in a repricing, but it does need to show resilience on the days it should be weak. Fifth, watch volatility itself. If volatility stays elevated and price stays bid, you're often in a regime where late bears get punished. If volatility spikes and price breaks key zones and stays broken, that's a regime shift warning. But that's not the part that matters. The part that matters is how you avoid being emotionally farmed by the exact volatility that makes this move so fascinating. Let me say something that sounds obvious but saves people. You are not competing against the market. You're competing against your own impulse to react. The market will throw you 3 kinds of emotional bait. First, the you relate bait, a sharp rally that makes you feel stupid for not being in, so you chase at the worst price. Second, the it-s over bait, a sudden flush that makes you feel stupid for being in, so you sell at the worst price. Third, the certainty bait. Confident voices telling you they know exactly what S is about to happen, so you stop thinking in scenarios and start worshiping a single outcome. The defense is simple. Define your time frame, define your invalidation, accept volatility as the cost of admission, and remember that markets rarely reward the most emotional version of your thesis. They reward discipline, they reward patience when others are frantic, and they reward people who watch structure instead of tweets. And that's where the real pressure starts. Now let's revisit the 309 idea in a way that's finance credible. 309 is not a base case target you tattoo on your brain. It is a number that can show up in the conversation when you model squeeze case convexity across a regime shift and assume the market enters an extended period where immediate availability is prized. Positioning becomes one-sided, and volatility stays high enough that hedging flows dominate price discovery. In other words, it's the kind of upside you get when the market stops being about value and becomes about clearance. Clearance as in, at what price do the forced buyers finally clear the market? That price can look absurd in advance. In the moment, it looks inevitable, and then afterward it looks absurd again. That's the nature of convex phases. They're unstable, they're dangerous, they're also real. The responsible way to treat that is not to promise it, it's to understand the conditions under which upside becomes nonlinear, and to watch for those conditions. If those conditions do not appear, you don't force the narrative. You trade what's in front of you, but that's not the part that matters. The part that matters is how you distinguish a normal rally from a structural repricing that can keep surprising people. A normal rally is satisfied by price. A structural repricing is satisfied by resolution, by easing of tightness, by relaxation of urgency, by changes in financing conditions, by shifts in positioning, by the system finding comfort again. If you don't see that comfort returning, you shouldn't assume it must come down just because the chart looks stretched. Stretched charts can get more stretched. The market can remain irrational longer than you can remain overconfident. That line gets repeated because it's true, but it's especially true in thin, reflexive metals where leverage and hedging flows can dominate for bursts. The smarter approach is to treat the market like a pressure system. Pressure builds, releases, rebuilds. Your job is to know what kind of release you smart kan bli seeing. A release that resets leverage but preserves the trend, or a release that breaks structure and changes the regime. And you can't know that if you're only staring at spot price. So what's the single most useful way to anchor yourself this week? Hit S to watch the tell that moves before the headline does. The market S, appetite for immediacy. You don't need to become a spreads wizard overnight. You just need to respect that when the market pays up for now versus later, it's communicating urgency. When that urgency stays elevated through pullbacks, it's communicating that supply and deliverability are still not relaxed. When that urgency collapses, it's communicating relief. Relief can be temporary, it can be meaningful, but it's information either way. And information is what you trade, not ego. Now, let's talk about what would actually invalidate the bullish near-term setup, because this is the grown-up part and most people avoid it. Invalidation is not a red day. Invalidation is a sustained loss of a key support zone after a breakout, followed by failure to reclaim it, coupled with visible relaxation in urgency signals and a shift in cross-market conditions that remove the macro bid. If that happens, the market may still be in a long-term bull case, but the squeeze case is off the table and the repricing phase is likely pausing or correcting deeper. That's not a tragedy, that's a map, and maps are power. Meanwhile, confirmation is not another green candle. Confirmation is price holding above the breakout zones, resisting deeper pullbacks, and maintaining that undertone of urgency in the structure while the calendar window pressures participants to act. Those are the conditions under which upside can keep surprising people. Those are also the conditions under which you should treat leverage like a live wire. Because volatility is how the market taxes greed. And that brings us to the quiet warning that separates the tourists from the operators. If silver is entering a reflexive phase, volatility will be used against you. You will see violent intraday swings that look like the end of the world. You will see social feeds weaponize those swings into certainty. You will see people bragging at tops and vanishing at bottoms. The market will try to train you to do the wrong thing automatically. It will try to make you buy high and sell low without thinking. Your shield is preparation. Your shield is scenarios. Your shield is remembering that pullbacks can be part of a bullish process and rips can be part of a bearish trap. Your shield is watching structure and making decisions when your nervous system is calm, not when it's hijacked. And if you can do that, you stop being liquidity for someone else's exit. That's where the real pressure starts. So here is the payoff I promised at the start. What to watch next week and the week after in one clean mental model. Watch for a controlled retest into prior breakout areas that stabilizes quickly while urgency remains stubborn. that SA market resetting leverage, not breaking. Watch for continuation behavior through psychological thresholds with shallow pullbacks and fast recoveries into option windows. That SA market flirting with squeeze dynamics. Watch for margin-driven flushes and ask the correct question. Did the structure break or did leverage just get cleaned? Watch cross-market headwinds and ask the correct question. Did silver lose resilience on the days it should be strong? And always watch for the moment the market stops paying for immediacy. Because that's the canary, that's the tell. That's the metric most people ignore while they argue about opinions. And if you track that, you're not just watching silver, you're watching the pressure system that moves silver. If you're the kind of investor who wants clean, institutional-grade logic without being spoon-fed a fairy tale, you already know what to do. Stop outsourcing your conviction to headlines and start tracking the mechanics that force people to act. The crowd will keep swinging between euphoria and despair. Let them. The advantage is not predicting the next candle. The advantage is understanding what the system is forced to do when time gets expensive, when margin gets tighter, when hedges flip, and when liquidity thins. And if you want to be around the people who trade like that, skeptical mechanism first and allergic to hype, stick close. Because the next 2 weeks are going to reveal whether this repricing is just a spike or the start of a phase that makes everyone re-rate what impossible looks like in a metal market.